Everybody is chatting about how high silver may go. Intrigued? No one asked the question that truly defends your wealth right today. How deep could it drop? Because here is the reality that many silver video makers will never state on film. Hushed. Silver is presently resting in one of the most perilous technical formations of this entire 2026 bull cycle. The graphs are not lying. And if you do not comprehend what they are revealing right now, you might watch months of profits evaporate before you even notice what occurred. Breathe deeply. I'm going to show you the precise price levels, the precise indicators, and the precise situation that drives silver considerably lower from here. Not because I feel bearish regarding silver, but because the traders who endure turbulent markets are the people who comprehend both sides of a trade. This is Growth Grid, reason, not hype. Let us begin with where we stand right now, because the background matters immensely. Silver reached an all-time peak of $120 per ounce back in January 2026. This came after an absolutely monumental 2025, where the metal surged almost 150% in a single year. 150%. This is the greatest yearly performance silver has registered since the late 1970s. Now, silver is trading in the low 80s. Thus, the first query every serious investor ought to address is this. Is this simply a healthy retracement inside a bull market, or is this the start of something much more severe? The charts are giving us a very detailed answer, and it is not the response most people wish to hear. Here is what the technical landscape actually looks like right today. Following that top at $120, silver has crashed through multiple support levels on its way down. The first major line of defense sat around $93, crushed. The next was $88, broken. Silver is now testing what experts are dubbing the most crucial support zone of the entire year, $80 through $84. This is not simply a random figure on a chart. This area signifies where the major institutional price forecasts for 2026 are gathered. It is the floor that the smart money penciled in at the start of the year as their base case average. And right now, silver is resting exactly on top of it. Here is why this matters so deeply. When value rests on top of a major institutional support zone, one of two things occurs. Either the buyers who have been waiting step in forcefully, absorb the selling and launch a rebound, or the support breaks. And when vital support breaks, it does not simply become neutral territory. It flips into resistance, which implies the next time silver tries to surge back above $80, it will face sellers who are now trapped from higher prices and are desperate to get out even. That is how pullbacks become something worse. Now let me show you the specific levels that experts are tracking on the downside, because this is the part of the story nobody on YouTube is mapping out for you. If silver loses the $80 mark on a weekly close, the first target to the downside is $73 to $76. Why that area? Because that is where the most recent breakout rally started before silver surged toward 120. Markets hold a memory. Breakout areas become support areas on the way back down. But here is where things get uncomfortable. If 73 through 76 does not hold, the next major support sits at $69 to $70. That is the zone that multiple technical experts, including groups at investing.com, have flagged as the deeper support structure for 2026. A drop to $70 from current prices around 82 would represent roughly a 15% additional decline from here, on top of the drop that has already happened. And if $69 to $70 falls, you start hearing experts talk about $60. At $60, you could be looking at a 50% total decline from the all-time high. Now, before you panic, let me be extremely clear. This is not the primary case. This is the worst-case scenario that experts are stress testing. Yet the fact that serious institutional experts are running this scenario at all tells you something important. This is not a market where you can afford to be reckless. So what could actually cause silver to drop that far? There are three specific obstacles that the charts are warning about right now. Obstacle number one, the dollar is getting stronger at exactly the wrong time. The US dollar index just hit a multi-month peak. Every time the currency strengthens significantly, silver faces mechanical selling pressure. Why? Because silver is priced in dollars globally. A stronger dollar means every foreign buyer is effectively paying more for silver in their own currency. This kills demand at the margin, and right now, the dollar is getting a boost from something very specific. The appointment of Kevin Walsh as the new Federal Reserve Chair. Walsh is known as an inflation hawk. Markets are now pricing in a scenario where rate cuts that were expected in mid-2026 get pushed back to late 2026 or removed entirely. Higher for longer interest rates, stronger dollar, more pressure on silver. That is the macro obstacle sitting directly in front of this metal right now. Obstacle number 2, the RSI and momentum indicators are broken. For investors who are not familiar with technical analysis, the RSI is a tool that measures whether an asset is being bought aggressively or sold aggressively. When silver was surging from $65 to $120, the RSI was showing extreme buying pressure. Today, it is showing something very different. The momentum has shifted. Technical experts are pointing to what is called a change of character on the charts. That is the technical term for when a market that was making higher highs and higher lows suddenly starts making lower highs and lower lows. Silver just made a lower high. It just made a lower low. That is not a healthy correction signal. That is the market telling you the short-term trend has changed direction. Until silver reclaims specific levels on the upside that I will get to in a moment, the technical picture favors more downside before any sustainable recovery. Obstacle number 3, the overbought hangover. This is the obstacle that most people completely ignore, and it is probably the most important one. Silver jumped 150% in 2025. 150%. Within markets, moves of that scale always leave a hangover. Not because the asset is bad, not because the fundamentals shifted, but because of something extremely simple. Too many people bought at too many different prices on the way up, and not all of them possess the conviction to hold through a serious correction. When silver sat at $120, there were investors who bought at $110, at $100, at $95, at $90, and at $85. Every single one of those buyers is currently sitting on a loss. And as price comes back down through each of those levels, some percentage of those investors decide their pain threshold has been reached, and they sell. This creates a wall of trapped sellers above the current price. It is called overhead supply, and it is one of the biggest technical obstacles silver faces right now. The chart is not just fighting bulls and bears. It is fighting an entire year of buyers who are looking for any rally to reduce their losses. Now here is the side of the story that prevents this from becoming a catastrophe. Because the obstacles are real, but so is the foundation underneath this market, the supply deficit. The Silver Institute has confirmed that 2025 marked the 5th consecutive year where global silver demand exceeded mine supply, 5 years in a row. The cumulative shortfall since 2021 has now climbed above 820 million ounces. Let me put that number in perspective. That is roughly equal to an entire year of global silver mining output. Gone, consumed, not sitting in a vault somewhere. And the structural demand that is consuming silver is not going away. Solar panel installations hit a global record in 2025 and are accelerating in 2026. Each new generation of AI data center servers uses 3.5 times more silver than traditional hardware. Electric vehicle production continues to grow, and EVs require significantly more silver per unit than conventional vehicles. Mine supply is essentially flat at around 813 million ounces annually. New large-scale mining projects take 7 to 15 years to develop and come online. There is no supply relief coming in the next 12 to 24 months. Bank of America's metals research team has one of the most aggressive targets on Wall Street. They see silver reaching anywhere between $135 and $39 per ounce before the end of 2026. That wide range is intentional. The lower end assumes a natural bull market continuation. The upper end assumes a physical delivery squeeze, the kind of event where paper markets cannot keep up with demand for real physical metal. Neither scenario requires a miracle. Both scenarios require time. So what does this all mean practically? Here is the decision framework that serious experts are using right now. Watch $80 on the weekly close. That is the line. A weekly close above $80 means the bull trend is damaged but alive. Dips into the high 70s and low 80s are accumulation zones for patient long-term capital. A decisive weekly close below $80 changes the entire picture. In that scenario, 73 to 76 becomes the next target. And you do not want to be adding aggressively until price finds footing and starts making higher lows again. On the upside, the level that confirms the recovery is $87 to $88. That is where overhead supply from trapped sellers gets worked through. A daily close back above 88 signals that the correction is over and the next leg higher is beginning. Above that, the $91 level is the confirmation that the bull is fully back in control. And above 91, there is very little standing between silver and a retest of the $100 psychological level. The game is not complicated. The game is patient. Watch 80 on the weekly close. Watch 88 on the daily close for the all-clear signal. Do not add aggressively until you see one of those two confirmations. Let me leave you with the honest summary. Silver is facing real obstacles right now. The charts are showing a broken short-term trend, overhead supply from trapped buyers, a stronger dollar, and the possibility of higher for longer interest rates. The worst-case scenario has silver testing $69 to $70 before this correction is finished. The base case sees silver holding the 80 to 84 support and building a base for the next move higher. The structural case, the 5-year supply deficit, the solar demand, the AI infrastructure build, the drained COMEX inventories, that has not changed at all. The price on your screen is not the same thing as the value of the metal, and right now there is a significant gap between the two. The investors who understand that gap and position accordingly are the ones who will look back on this period as the best buying opportunity of 2026. The investors who chase prices higher or panic sell lower are the ones who fund those gains for everyone else. Know your levels, respect the chart, trust the fundamentals. That is how you survive a market like this. If this breakdown gave you something that other channels did not, hit subscribe. Growth Grid covers silver, gold, rates, and macro every week with no hype and no agenda. Drop your questions below. I read every comment. Stay sharp.